Morning, everybody. Nice to see a full house. Nice to see some smiles on some faces here for a change. Okay, how many people are survivors of the last 4 or 5 years? Put up your hands. How many people's IQ went up 30 points in the last month? Put up your hands. Nice. Okay. We're so smart, aren't we? Okay, first slide, please. I wanted to do this introduction, the way I knew Brent wanted it, and Brent always refers to this as the MIF conference. That confused me a little bit until he explained it to me. So, you guys you're a sophisticated audience. I probably don't need to tell you what the term MILF means. I'm sure there's several MILFs in the audience. Who knows, there may even be a MILF on the stage. It's possible. And, of course, you know what I'm saying here. Minors I'd like to finance. That's the market we're in now, folks. It's back on. Topic of my talk this morning is outside money. This is something I've been sort of talking about for 3 or 4 months to subscribers. And it's important to understand that I think what's driving, especially at the higher level, at the top of the food chain, if you will, a lot of what's driving this is not sector insiders. We've all been beaten up for 4 or 5 years. You look at the change in volume and the change in dollar volume in a lot of these companies in the last 2 or 3 months. Some of that is us jumping back in, but for sure, a lot of this is money coming from outside the sector, and it doesn't view things quite the same way, and I don't think it's got quite the same underpinnings or objectives, and it's important to keep in mind that right now I think there's going to be 2 opposing forces. I think those of us that are spent 4 or 5 years getting beaten up, we're going to be fast on the trigger. We're all paranoid. The first time things drop a day or two, we're bailing. And I think the other side of it, the buying coming in, a lot of that's coming in from outside the sector, from generalists. And I'm going to try to walk through why I think they're here and how I think they might be a little different. Okay, obviously bottom in December, uptrend flattened a little bit in the last month. That got people a little bit nervous. To me, it doesn't seem like that scary a chart. Obviously, the US dollar is a big factor, but it's not the only factor, and I think it's very important to understand that from the generalist side of the table, I'm not even convinced it's the main factor, and I'll explain to you why I think that's different. I think most of the recent rallies have been generalist driven, so what is it? Why are those guys here now when they weren't here a year ago or 3 years ago or 4 years ago? What happened to change their opinion? There's the gold chart. It's not really that scary on a short-term basis. Yeah, it's had a big climb, but you look at a 3 or 5 year chart, it's not really that impressive. And if you look at the relative strength over on the right side of the chart where I've circled, it definitely got overbought when we first had that big swoop that took us up to 1,200. But with the sideways action, it's fairly neutral right now. Things can always happen to make the stuff drop, but I'm not one of those guys who's waiting for the next drop. I know there's a big school of thought that we have to go back to 1,000 or 900 or whatever the number is. Personally, I don't think that's going to happen. We'll get pullbacks, but I don't see this, big $200 or $300 an ounce drop. I think we're past that now. If you look at the U.S. dollar, and this is something I went into a couple of months ago, yes, the U.S. dollar topped in December. That's a big factor. What's interesting to me is what changed. The U.S. dollar was the long trade last year on Wall Street, in London. It was so overcrowded, it was ridiculous. I thought the dollar was going to roll over in part because of that. The crowd got so into this. Everything was so one-sided. But if you look at those spots that I drew arrows to, what's interesting is what happened in the last 3 or 4 months. A lot of the big drops in the U.S. dollar weren't because the dollar dropped. Remember, currency trades are always two-sided. It was because either the yen surged or the euro surged. And all those things that I'm pointing to are either Bank of Japan meetings or ECB meetings where traders were disappointed by the lack, quote unquote, of action by the central bankers, which was obviously a big shock for BOJ Chairman Kuroda and Draghi at the ECB, because these guys were throwing everything but the kitchen sink at it. But traders' expectations just got so ridiculously high in terms of what they wanted out of these bankers, in terms of liquidity injections and QE. Nothing would satisfy these guys. Kuroda went to negative rates and the yen went through the roof. It was nuts. This is the market that we're in. This is the backdrop that the generalists are looking at. It's not about the dollar's going to zero. It's not about, stock up on your coins and dried food and order your plans to build a bunker in the backyard off the TV show. This is guys that are looking at totally different stuff, in my opinion. So basically, the unwinding was really disappointment in central bank actions. It was also, and this was something else that I expected, the growth curves of the US and the euro actually came together a little bit, essentially because the US has slowed down. Their growth rates decelerated a little bit. Right now, I would say the position is generally short. I think there's probably some room. There was a bounce in the last few sessions of the US dollar. We could see some more bounces in the near future. I think it's swung maybe a little bit too far the other way. Generally, the bond market, the bond traders have no belief that the Fed's going to raise rates. I think that's probably a little bit complacent. I think the odds of the Fed raising rates, say at the next meeting, with a couple more pieces of generally good data are higher than people think. They're very worried about spooking the market, but I think they're even more worried about being caught with only one rate cut if things turn down. I don't think they'll do it if they think the market's going to blow up on them, but I think they want to do it. They're just looking for enough good data points to pull the trigger. But I don't think that's going to be the end of the world. You'd see the dollar go up that day. You'd probably see gold get whacked for 50 bucks that day. But again, there's other things driving this. Here's a one-year chart for the 10-year yields in the US. You look at the big spike down in February. That happened basically when the S&P had its big drop. That's essentially a safety trade. That's traders diving into the treasury market. They bid up the price of treasuries, they're bidding down the yield. That's basically a risk-off trade, pure and simple. If you look at the drops more recently, there's a couple of sawtooths at the end. Those are interesting because those came in the face of a slightly higher dollar and better, not great, but better metrics on 2 or 3 of the big economic indicators in the US. And I think what you're seeing with a big chunk of this downtrend is essentially bond traders from Japan, from Europe, other places internationally being driven into the US bond market because a huge percentage of the government bonds in Asia and in Europe now have negative yields. They're issuing at negative yields. You've got basically bond traders, bond funds going to the US seeking yield. When they buy the bonds, they up the price, they lower the yield. So in effect, they're almost like an external QE program for the Fed that it doesn't have to pay for. That's, I think, mainly what's been driving bond yields down. Bond yields matter. Real bond yields matter a lot. This is something, again, I've been harping on for a while. This chart is a little tricky. If you look at the blue line is the gold price. The red line, and it's inverted, is the 7 to 10 year. They did an average of the 7 to 10 year bond yield, the real yield. And if you see periods where you see that red line going up, lower left, upper right, and remember it's inverted, so when you see that, that means yields are falling. That's very supportive of gold. It's supportive of commodities generally. I mean, I'm sure you've heard stories over the years about people talking about the Fed being behind the curve. When they say behind the curve, they mean behind the inflation curve. I don't see a huge amount of inflation coming short term, but right now the Fed and definitely Japan, ECB, most of the European central banks are way behind the curve. They've gone down to negative yields. If you look at very long-term trends, 50, 100-year trends, negative yield periods are very supportive of commodities. They are particularly supportive of precious metals. That's something that's held true over decades and decades and decades. And that is what a lot of the generalists are looking at. It's not, what do I think the dollar is going to do next week? It's not, I hate the politics. It's like, no, it's not geopolitical. I mean, you'll get spikes, things up and down because of that. I think the main story they're looking at is negative yields. And that's very good for us because this is not something that can be changed very quickly. If you take a look at this is just a spider. It's sort of the main GLD ETF. I just threw that up there for giggles. I mean, that shows you the holdings in the spider ETF. If you look on the right side of it, which is the last couple of months, that's really the first significant increase in GLD holdings, really since there was a bit of a blip in 2012, but really you got to go back to 2009, 2010 to see that kind of a move. A lot of that's probably retail, but there is fund money flowing into those as well because it's simple, it's easy. They don't have to think about it too much. Remember, most of the people coming into the sector probably don't know a huge amount about it other than the real basics. You take a look at these two charts now. These are one-year charts. One on the left is the venture index. One on the right is the GDX. This shows you, these are scary, steep trajectories, but you know, we got to keep a little bit of perspective on that, and I'll move to that in a minute. But this shows you, you know, GDX is, you know, sort of the top end, the bigger companies. CDNX is the bottom. You're seeing both sides of this. The money's flowing in much faster than people expected, I think. I don't think it's going to be a rising tide lifts all boats. I don't think it should be. I hope that it isn't, frankly. There's a lot of companies that probably don't deserve to get resuscitated, and I think you want to stick to quality, and of course that's the whole point of this conference and other ones like it. This is the central point that I've been trying to get across to readers that you've got to understand. There's two worldviews here. There's guys like us that got dragged through this bear market and probably once before it. We tend to take a very short term because we've been focused on this day after day. They're taking a look at this. This is a one-year chart of the GDX. Sacrilege for technical guys, but I made this basically a linear rather than a logarithmic scale just to show the differences. They're looking at the left side. They're seeing this giant cliff. They're going, oh my God, we're all going to die. I got to get some paper off. Sell in May, sell in April, sell in July. Oh my God. You've got the generalist, who's a guy who has had no interest in this sector whatsoever. He's not a gold bug. He's not going, and understand this, it's important. He's not going to be a gold bug. Like, this is simply asset allocation. You're talking about guys with $500 billion funds going, be able to go from 0 to 0.2. 0.2 in his case is 300 million bucks. I mean, it's a very different mindset. He's looking at a 5-year chart. He's going, yeah, it's a trend change. I should be worried about this? What's the big deal? Those guys, when they move into sectors, they tend to move for 2 to 4 years, simply because, you know, they're like super tankers. It's very hard to get those guys in. Telling those guys this stuff was undervalued for 3 years got you nowhere. They wouldn't even answer the phone. They're starting to come into this stuff now. I suspect as they do that, we're probably looking at a 2 to 3 or 4 year bull market, because it simply takes that long for these guys to move in and out of a sector. You know, that doesn't mean we aren't going to have huge swings in between. It doesn't mean some stock you love isn't going to put out a bunch of duster holes and get cut in half. I mean, there's still sector risks, there's still individual company risks, but I think this is a new bull market, pure and simple. Here's the big picture. Falling US helped kick it off, but again, main underpinnings is a long-term trend in negative real rates. It's going to be very difficult for the world central banks to get themselves out of that corner. I don't think it's going to happen very fast. That rate environment is going to be with us for quite a while. Institutional money, like I said, very slow moving, obviously top down. I mean, they're not coming in to buy 10-cent stocks. They're starting with Goldcorp and Newmont and Barrick and, you know, all the usual suspects. But they push money down the pipeline. As those guys take up all of the top line placements, money gets pushed down the pipeline, and we've seen that happen very quickly. And I think, you know, we're all looking at stuff. I mean, I know I am, I'm sure you are, that's gone up, you know, 100%, 200%, 300% in ridiculously short amount of time. I'm not saying, like, hang on tight and don't ever sell anything. Anybody that gets my newsletter knows, like the last newsletter, I was just saying over and over and over again, you know, this is a great stock. I told you you should buy this thing in November because of this. It's up 900%. If this stock owes you any money, do not phone me, do not call me, do not email me if something goes wrong, if it drops, because I will not be sympathetic. You're an idiot. Take money off the table. Not everything, not most of it, but if the market's giving you, especially on things like drill plays, and everybody knows I love drill plays, if the market's giving you a chance to have a free ride on a drill play, you should take it. You know, I'm not saying get rid of everything. I'm saying if you bought it for 10 and it's selling for 50, you sell enough so that it's a risk-free trade for you. It doesn't get any better than that, folks. Next few months, I think and probably the next few years, we're going to have this standoff between sector insiders and outside money. Insiders are scared. They should be. We've all, you know, I don't think we should forget the lessons that we learned through 4 or 5 terrible years. They'll be the quickest ones to sell on pullback. Outside money, a lot of that's not even positioned yet. I mean, these guys aren't idiots either. They're going to be waiting for pullbacks. Some of them are going to maybe buy their way through if there's, say, a weak summer for these things, or there's a pullback in the gold price. But my basic thesis is you're talking about so much more buying power in the case of the outside money than the inside money, that I think it's quite possible things are going to hold up better than everybody expects. If you go back to 2009, you go back to early in the cycle coming out of 2003, we had fairly long runs where you didn't really see much of a pullback. It took a long time. I'm not saying you should never sell stuff. I just told you that you have to sell stuff and manage your money. But I wouldn't be that shocked if we don't see anything significant for a few months. That would actually be normal coming out of a bear market this bad. You do tend to get a fairly long run when it finally turns. And obviously the other thing that's happening right now, you do have overbought ones, but like I said, the outside money to help cushion M&A activity. Thanks, Ira. That's going to recirculate a bunch of inside money, absolutely. Yeah. Because that, in a lot of cases, that is inside money. That's gold fund money, that's retail investors. We've seen 2 or 3 of those, and we just saw it with Reservoir a couple of weeks ago. That frees up money, that recirculates it. If you go back to some of the really sort of crazy-ass bull markets in this sector, quite often what really kicked them off was a series of M&A transactions that freed up a bunch of money and just kept recirculating it. And we may see that too. I don't know who the next week picked off will be, but there's going to be more. As our buddy Brent reminds us constantly, there isn't a lot in the pipeline, and there's a lot of majors that are going to have to go out and buy it if they want to own it. Basically, if you've been living this for the last 5 years, things feel expensive. I don't disagree. You should never be buying anything you're not comfortable with anyway. But just remember, when you come out of a bear market like this, things are going to feel expensive. Everything's going to feel expensive because you're so used to getting the share price whacked down. That's how it's supposed to be. If everybody was comfortable, if I was talking to guys around inside the sector and talking to guys at the company, and everybody was saying, yeehaw, happy times are here again, it's go time, let's go crazy, I'd be standing here telling you to sell stuff. That's not what I'm hearing. Guys are still really paranoid, but that is actually what you want. That's how bull markets work. They don't call it a wall of worry for nothing. Quality will out. You're seeing a lot of stuff move, but that doesn't just mean you should be indiscriminate. Pick quality companies, quality management. I'm a little less, but not unworried about financing, but I'm obviously less worried than I would have been 6 months ago. Good management teams and good projects are not having any trouble finding money right now. It may not be the price they want, but they can find it. So that's a little bit less of a concern than it would have been 6 months ago. I would have said forget it if they don't have cash. I'm a little more willing to go out on a limb and give guys a chance to raise money, although I prefer that they already have it. Discoveries are working again. We haven't seen many. It's been a bit of a drought, really. You go back the last few years, there really have not been, the whole cycle back to 2008, there really haven't been that many discoveries. There's a handful of them like Coffin, but not a huge number when you see how much money got thrown at the space. There's a fair amount of luck and statistics involved here, and I think we're probably overdue for a few. So I'm hoping to see some discoveries, and obviously that will drive things even more. Look for developers that have, in my own preference is to look for companies, if I'm buying developer level stocks, I like stocks that make sense now. I don't like to buy stock. I'm not a big optionality fan. I'm not one of those guys that says this stock will do great if gold goes to $2,000. It will. Like something that's totally uneconomic now will probably have a bigger percentage move, but personally, if I'm buying stuff at that level, I prefer to buy something where I'm comfortable the project probably works right now at today's prices in today's world. I don't want to have to count on that much of a change in worldview for it to make sense. Biggest near-term risk is a surprise rate increase. The market's not pricing one in at all. I'm not sure what the odds are, but they're definitely not zero. I mean, the Fed wants to raise rates. They don't want to raise them a lot, but they'd really like to have 1 or 2 more rate increases behind them to give them a bit of a cushion because they really don't have one now. They're not going to do it if it's going to blow the market, but I definitely wouldn't say the odds are zero. So, I mean, I wouldn't go into the next Fed meeting assuming there's no chance it's going to raise rates. I think there's, I would say 30% chance right now that they are in fact going to do it. And again, just make sure it's a bull market again. This is great. Just take partial profits occasionally, get your cost base down. I love drill plays. I tend to get in before them. So, if you can be in a position where your average cost goes from, 20 cents to 5 cents because you sold 20% of it, that's what you want to be doing. The simple truth of the matter is most exploration projects will not work out. Most exploration projects will not become mines. That's how it is. That's the reality of the exploration business. So you want to trade to give yourself the best chance to diversify and keep giving yourself new opportunities as you go along and hang on enough so that if they hit something, you're the one with the bragging rights. I think we're going to have some fun here for a while again, guys. Good luck, good trading. I'm done.